Welcome to California's 2025 housing market, a market that's finally showing what happens after years of nonstop growth meet economic reality. For more than a decade, it felt like home prices here could only move in one direction, up. Between ultra-low interest rates, remote work, and endless demand from investors and out-of-state buyers, even small starter homes were suddenly selling for seven figures. But that momentum is slowing down fast. Now, the numbers tell a different story. Inventory is rising in many key markets. Sellers are cutting prices more often, and buyers, squeezed by higher mortgage rates and insurance premiums, are stepping back. For the first time in years, the California housing market isn't defined by bidding wars. It's determined by hesitation. We're also seeing new trends that didn't exist just a few years ago. More homeowners moving out of state in search of affordability. Insurance companies are scaling back coverage in high-risk areas. There is a growing divide between what sellers think their homes are worth and what buyers can actually afford. All of this is creating pressure, and in certain cities, that pressure is building faster than anywhere else. This is HouseLine USA, and in this video, we'll look at 10 California cities where home prices are showing clear signs of vulnerability in 2025. These aren't just random markets. They're areas where local economics, affordability, and investor activity are setting the stage for potential price corrections. Some of these cities have been considered safe bets for years. Others are already seeing demand cool off, with homes sitting longer and sellers adjusting expectations. But taken together, they show a broader shift in how California real estate really works now. By the end of this list, you'll have a better sense of where the market is softening, what's driving it, and what it could mean for homeowners and buyers over the next year. Let's get into it. Starting with a city that became one of California's hottest pandemic markets, but where rising costs and fading investor demand are quickly changing the picture. Number 10, Palm Springs. You start in the desert. Palm Springs, the city that once looked like an endless success story. For years, this was the perfect escape. Mid-century modern homes, mountain views, and a lifestyle that blended luxury with laid-back charm. During the pandemic, it went from a quiet retirement town to an investment hotspot almost overnight. Remote workers, Airbnb hosts, and second home buyers flooded in, convinced the market could only go up. And for a while, they were right. Home prices in the Coachella Valley surged more than 40% between 2020 and 2023. Bidding wars were common, and properties that had once sat for months were gone within days, often to out-of-state investors looking for short-term rental income. But the momentum that fueled that boom is now turning into a serious problem. Tourism, the lifeblood of Palm Springs, has started to cool off. Travel spending is down compared to last year, and higher living costs are cutting into vacation budgets. Meanwhile, stricter local rules on vacation rentals have reduced profitability for investors, shrinking the pool of buyers who once kept prices rising. According to data from the Palm Springs Regional Association of Realtors, nearly 40% of homes sold here in the last few years went to investors or second home buyers. Many of those purchases were financed with adjustable-rate loans that are now resetting at much higher interest rates. For owners depending on steady Airbnb bookings, rising mortgage costs and declining occupancy rates have turned those once lucrative rentals into monthly losses. Inventory has jumped sharply across the Coachella Valley, with active listings up over 30% year over year, and homes that used to sell in a weekend are now sitting for 60 days or more. Price reductions are becoming standard, not the exception. Palm Springs isn't crashing yet, but the warning signs are there. High investor exposure, slowing tourism, and a growing gap between what homes cost and what the local economy can support. The desert boom that looked unstoppable just a couple of years ago is starting to fade. And for many investors, the sunshine is giving way to a serious financial hangover. But if you think Palm Springs is struggling, wait until you see what's happening in California's tech capital. Number 9, San Jose. Welcome to San Jose, the unofficial capital of Silicon Valley and one of the most expensive housing markets in the entire country. For years, prices here were fueled by one thing: tech wealth. Stock options, IPO windfalls, and high-paying software jobs turned modest ranch homes into million-dollar listings. Demand seemed endless, and sellers could practically name their price. But that dynamic is changing fast. Over the last year, major employers like Google, Meta, and Cisco have announced hiring freezes or layoffs, cutting thousands of high-income positions from the Bay Area job market. At the same time, remote work flexibility means many workers no longer need to live near headquarters, and a growing share are leaving California altogether for lower-cost states such as Texas and Utah. The impact on housing has been immediate. According to recent Zillow data, inventory in Santa Clara County is up more than 25% year over year, while pending sales have fallen sharply. The median home price still hovers around $1.7 million, but the number of listings with price reductions has more than doubled compared to 2023. Homes that once drew 10 all-cash offers now sit for weeks, waiting for a single serious buyer. Another pressure point is affordability. Even with strong tech salaries, the price-to-income ratio here remains one of the worst in the nation. A typical household would need to earn well over $300,000 a year to comfortably afford the median-priced home, far above the region's actual median income. Add in higher mortgage rates and insurance costs, and the math simply doesn't work anymore. Developers are slowing new construction, luxury condos are piling up unsold, and investor interest has cooled as rents level off. The housing market that once thrived on speculative confidence is now being forced to stand on real economic fundamentals. And those fundamentals are weakening. San Jose isn't collapsing overnight, but the foundation of its growth, ever-rising tech salaries and endless capital, isn't guaranteed anymore. Without that constant fuel, even Silicon Valley's housing engine can stall. And while the valley's shine is fading, the so-called affordable escape city to the east is running out of gas too. Number 8. Riverside. Head east from Los Angeles and you'll find Riverside, the long-standing escape hatch for people who couldn't afford coastal prices. For decades, it was marketed as the last bastion of middle-class homeownership in Southern California. More space, lower prices, and that drive-till-you-qualify lifestyle. But that trade-off is becoming harder to justify. According to the California Association of Realtors, only about 20% of local households can now afford the median-priced home in Riverside County, one of the lowest affordability rates in the entire state. The median price is hovering around $600,000, which doesn't sound extreme compared to Orange County or Los Angeles. But for a region with an average household income of near $90,000, it's a stretch that's reaching its limit. The local economy also depends heavily on two sectors that are both showing signs of strain: logistics and long-distance commuting. The Inland Empire became a hub for massive warehouse and distribution centers during the e-commerce boom. But with online shopping growth slowing and companies cutting back on excess inventory, new warehouse construction and hiring have dropped noticeably. That slowdown hits the regional job market directly, cutting into the income base that supports local housing demand. Then there's the commuter problem. For many families, buying in Riverside meant accepting a 2-hour drive each way to jobs in Los Angeles or Orange County. With gas prices above $5 per gallon for much of 2024 and continued return-to-office mandates, that daily routine is taking a real financial and emotional toll. What was once an affordable compromise now feels like an expensive burden. In housing data, the stress is clear. Listings are staying on the market longer, price cuts are becoming routine, and sellers are increasingly offering concessions just to move properties. Builders are slowing new projects, and buyer demand has cooled to its lowest level in nearly a decade. Riverside's affordability advantage, the one thing that made it appealing, is effectively gone. The area still offers sunshine and space, but the economic equation that powered its growth no longer adds up. And if that pressure sounds familiar, wait until we look at a coastal neighbor that's facing the same problem on a much bigger stage. Number 7. Long Beach. Long Beach has always been the in-between city, part coastal escape, part working port, and for years, the go-to alternative for people priced out of Los Angeles. It offered ocean views, character-filled neighborhoods, and a slightly more attainable entry point into Southern California real estate. But that gap between attainable and out of reach has quietly disappeared. The median home price still sits around $800,000, and even condos that once sold quickly are starting to linger. According to data from the California Regional MLS, days on market have increased by nearly 30% year over year, and sellers are becoming far more flexible, offering concessions and multiple price reductions just to get traction. One of Long Beach's biggest strengths, its connection to the Port of Los Angeles and the Port of Long Beach, has also become one of its biggest risks. The ports together form one of the largest trade gateways in the world, but global shipping volumes have softened. Slower trade, shifting supply chains, and lower consumer spending are creating ripple effects across the local job market, particularly in logistics, transportation, and warehousing. When the flow of goods slows, the regional economy feels it immediately. The rental market is also showing early signs of fatigue. New apartment developments along Ocean Boulevard and downtown have added much-needed supply, but with higher interest rates keeping potential buyers on the sidelines, landlords are offering move-in incentives to fill units. At the same time, property owners facing higher taxes and insurance premiums are passing those costs onto tenants, pushing overall affordability even further out of reach. For a long time, Long Beach's appeal came from its balance, close to Los Angeles, but not as expensive, coastal, but more accessible. Now, that balance is slipping. The city is caught between high ownership costs and a weakening demand base, squeezed by the same economic pressures hitting the rest of Southern California. The affordable alternative narrative that once defined Long Beach is fading. It's still cheaper than Santa Monica or Manhattan Beach, but not by enough to justify the trade-offs anymore. And speaking of Los Angeles, the city that once set the standard for luxury and success, its housing market is now caught in a very different kind of storm. Number 6, Los Angeles. Los Angeles, the city of dreams, a place where ambition built skylines, and real estate became as much a status symbol as a home. For decades, property here seemed untouchable, driven by entertainment money, global investors, and sheer demand for sunshine and opportunity. But in 2025, that shine is fading. The city's housing market is under pressure from multiple directions, and even its wealthiest neighborhoods are starting to feel it. One of the biggest shocks came from the mansion tax, officially known as Measure ULA. Introduced in 2023, it added a 4% tax on property sales above $5 million and 5.5% on those above $10 million. The goal was to fund affordable housing programs, but the side effect was an immediate freeze in high-end transactions. According to the Los Angeles County Assessor's Office, sales of homes above $5 million fell by more than 60% after the tax took effect. Sellers are holding off, buyers are negotiating harder, and luxury listings are stacking up with little movement. Meanwhile, another issue is hitting every level of the market: insurance. Major carriers like State Farm and Allstate have pulled back on new home policies across large parts of California, especially high-risk wildfire zones in Malibu, the Hollywood Hills, and Topanga Canyon. For homeowners who can still get coverage, premiums have surged, in some cases doubling or tripling. Others have had to turn to the state's high-risk insurance pool, known as FAIR, which offers limited protection at a steep price. The result is a strange kind of housing gridlock. Luxury owners can't sell without taking a hit, but staying means higher taxes, rising insurance costs, and a shrinking pool of qualified buyers. Even mid-tier neighborhoods like Studio City, Sherman Oaks, and Pasadena are seeing homes linger longer as affordability continues to erode. For a city once built on momentum and optimism, Los Angeles feels stuck. Its housing market isn't collapsing, but it's not moving either. And for investors and homeowners who rely on constant appreciation, stagnation can be just as painful. Los Angeles was built on aspiration. Today, it's running on hesitation. And just across the bay, another California city is facing a different kind of stall, one that's turning into a full-blown doom loop. Number 5, Oakland. Oakland has always been known as the Bay Area's more authentic, affordable counterpart to San Francisco. A city with deep cultural roots, creative energy, and a long-standing reputation for resilience. For years, it was the go-to alternative for first-time buyers, young professionals, and anyone priced out of San Francisco's relentless housing market. But in 2025, that equation is changing, and not in a good way. The city's downtown core is facing what analysts call a structural reset. Office vacancy rates have surged past 35%, among the highest in the nation. With the shift to remote and hybrid work, many tech and service companies have reduced or abandoned office leases entirely. Empty towers mean fewer daytime workers, less spending at local businesses, and a shrinking source of city revenue. The result is a self-reinforcing cycle. Declining activity leads to less investment, which leads to more vacancies. That economic slowdown is spilling into the housing market. While the median home price in Oakland still sits around $900,000, homes are now taking far longer to sell. Inventory has increased steadily, and price reductions have become commonplace as sellers adjust to a smaller pool of qualified buyers. Another key issue is perception, particularly around safety and public services. The city's budget strain has reduced funding for infrastructure and maintenance, and reports of property crime have increased. Even though not every neighborhood is affected equally, the broader reputation weighs heavily on buyer confidence. For many would-be homeowners, paying near San Francisco prices for a city struggling with visible challenges feels like a poor trade-off. On top of that, property taxes in Alameda County remain among the highest in the Bay Area, further discouraging new buyers. Investors who once saw Oakland as an up-and-coming market are pulling back, while some long-term owners are choosing to sell and relocate to less volatile areas. Oakland has weathered downturns before, but this time feels different. It's not just a temporary dip, it's a combination of economic, social, and fiscal pressures that will take years to unwind. The city that once represented the Bay Area's affordable alternative is now caught in a difficult middle ground, too expensive for new buyers, yet too uncertain for investors. And if the Bay Area's affordable option is struggling, what does that mean for the capital city that once became its escape route? Number 4. Sacramento. Welcome to Sacramento, California's capital and the city that became a temporary refuge during the pandemic housing rush. Between 2020 and 2022, Sacramento was one of the state's fastest-growing housing markets. As remote work took off, thousands of Bay Area residents packed up and headed inland, chasing larger homes and lower prices. The city's average home price jumped nearly 35% in just 2 years, and bidding wars became the norm, something that hadn't been seen in this market before. But by 2025, that momentum has shifted. The remote work wave that once fueled Sacramento's boom is receding. Companies across Silicon Valley and San Francisco have tightened hybrid policies or reinstated in-office requirements, reducing the incentive for high-income professionals to live 2 hours away. The result is a reverse migration, workers returning closer to their jobs and fewer Bay Area buyers competing for homes in Sacramento. The local data reflects this shift clearly. According to the Sacramento Association of Realtors, housing inventory has surged more than 45% year over year, and the number of homes sitting on the market for over 60 days has doubled compared to 2023. Median prices remain high, hovering near $550,000. But price growth has stalled. Sellers are increasingly offering concessions, while buyers are negotiating more aggressively, a sign of weakening leverage. Another challenge for Sacramento is its economic base. The city's job market relies heavily on government employment, education, and healthcare, which tend to provide stability but limited wage growth. Those steady incomes simply can't support the inflated home values created during the pandemic surge. And as mortgage rates remain elevated, affordability continues to deteriorate, sidelining many first-time buyers who make up a crucial share of the local market. Investors are also scaling back. During the pandemic, out-of-town investors bought aggressively, hoping to capitalize on rent growth. But with slower population inflows and rent stabilization laws tightening in California, many of those investors are exiting, adding more listings to an already growing supply. Sacramento's market isn't in free fall, but it's clearly cooling. The city that once seemed like a safe escape from Bay Area chaos is now facing its own affordability wall. The demand that once lifted has moved on, and what's left is a market trying to find its true value again. Next stop, a coastal paradise where beautiful weather can't hide one of the worst affordability gaps in the entire state. Number 3, San Diego. San Diego has always been the picture-perfect version of California, with blue skies, ocean breeze, and a housing market that seemed bulletproof. For years, the story was simple. Everyone wanted to live here, and almost no one wanted to leave. But in 2025, that story is starting to change. Behind the postcard image, the numbers tell a tougher truth. According to the University of San Diego's Burnham Moores Center for Real Estate, only about 10% of local households can afford the median-priced single-family home, which now sits just above $1 million. That means 9 out of 10 San Diegans are priced out of homeownership entirely, including the very people who keep the city running: teachers, healthcare workers, service industry employees, and military families. For years, steady demand and limited supply pushed prices higher, but inventory is quietly creeping up. Redfin data from mid-2025 shows that active listings have grown roughly 15% year over year, and the number of homes with price reductions is the highest it's been since 2019. Sellers who once expected quick offers are learning that today's buyers are far more cautious, especially with mortgage rates hovering between 6.5% and 7%. San Diego's economy is still strong, supported by tourism, defense, and biotech, but it's also narrowly focused. If there's a slowdown in federal defense spending or a pullback in biotech investment, that concentrated job base could quickly feel the strain. Combine that with rising insurance premiums and property taxes, and even longtime owners are starting to feel squeezed. Another emerging concern is migration. During the pandemic, San Diego gained thousands of remote workers and investors, many from higher-cost regions like Los Angeles and the Bay Area. But in 2025, that trend is reversing. Fewer new residents are arriving, while more local families are moving inland to Riverside County or out of state entirely, seeking affordability that San Diego simply can't offer anymore. For most residents, living in San Diego feels like renting paradise, a great place to visit, but nearly impossible to buy into. The sunshine is still free, but homeownership here has become a luxury few can reach. And speaking of luxury, our next stop takes us to a city built on master planning and exclusivity, where perfection itself is starting to lose its price premium. Number 2, Irvine. Irvine has long been seen as the model city, clean, organized, and perfectly planned from the ground up. Every neighborhood has its design guidelines. Every street looks manicured, and nearly everything feels intentional. It's a city built to represent safety, order, and long-term value. The idea that your investment here is as stable as it gets. But in 2025, that perception is being tested. According to recent data from Zillow and Redfin, active home listings in Irvine are up more than 20% year over year, a sharp jump for a city that typically has limited inventory. Homes that used to attract multiple offers within a week are now sitting on the market for a month or longer. The median home price remains around $1.5 million, but sales volume has dropped considerably as affordability hits a wall. For the average household, owning in Irvine has become nearly impossible. Based on local income data, a typical family would need to earn roughly $275,000 a year to comfortably afford a median-priced home, far beyond what most residents make. That means even highly paid professionals are getting priced out, leaving the market increasingly dependent on cash buyers, investors, or long-term homeowners with significant equity. On top of that, Irvine comes with layers of hidden costs. Beyond high property taxes, residents pay substantial HOA fees for community maintenance and Mello-Roos assessments, special taxes used to fund infrastructure and schools in newer developments. Together, these costs can add thousands of dollars per year, creating what many locals describe as a subscription fee for living in perfection. The challenge for Irvine is that its success formula, exclusivity, predictability, and pristine design, also limits its flexibility. The city has little room for affordable housing development, and the lack of diversity in price points makes it vulnerable when buyer demand slows. Even small shifts in interest rates or insurance costs can ripple through the market quickly. For years, Irvine symbolized the safe bet in California real estate, a place where value always held. But when safety becomes unaffordable, even the most stable market can start to wobble. And that brings us to the final stop, a city once considered the crown jewel of California, now facing what some analysts call a full-blown crisis. Number 1, San Francisco. San Francisco, once the heartbeat of innovation and the symbol of California's prosperity, is now facing one of the most complex housing challenges in the country. For years, its real estate market seemed untouchable. Tech money flooded in, startups turned employees into instant millionaires, and every square foot of the city felt like prime investment territory. But in 2025, that confidence has faded. The biggest issue isn't just housing, it's the entire urban ecosystem. Downtown San Francisco is struggling with an office vacancy rate approaching 40%, one of the highest of any major US city. When offices sit empty, surrounding businesses, coffee shops, restaurants, and retailers lose customers. The city collects less tax revenue, services decline, and overall quality of life starts to erode. It's a feedback loop economists now call the doom loop. The effects are showing up in housing. While the median home price still hovers near $1.2 million, it's down from its pandemic peak, and more sellers are accepting lower offers just to move properties. Condos in particular have been hit hard, with values down nearly 15% over the last 2 years as demand from tech workers and investors dries up. Rental prices, too, have flattened, signaling that population outflow hasn't fully stabilized. The U.S. Census Bureau reports that San Francisco's population has fallen by more than 7% since 2020, with many residents relocating to more affordable parts of California or out of state entirely. Meanwhile, rising insurance costs and stricter lending conditions have made it harder for new buyers to enter the market. Even those with strong incomes are thinking twice before purchasing in a city facing so much uncertainty. Analysts from UC Berkeley's Haas School of Business have modeled worst-case scenarios showing potential price declines of up to 70 to 80% in extreme economic or municipal distress. Not a forecast, but a reminder of how sensitive the city has become to financial shocks. San Francisco isn't disappearing, but it is redefining itself. The question isn't whether the city will recover, it's what recovery will look like, and who will still be able to afford to live there when it happens. And with that, we've reached the end of our list. 10 cities that show just how quickly California's housing market can change when fundamentals start to shift. For years, the story was simple. Buy anywhere in California, hold, and watch your equity grow. But that logic no longer works. Rising interest rates, higher insurance costs, population shifts, and stricter local policies are rewriting the rules. Even cities once thought to be immune, places like Irvine, San Diego, and San Francisco are facing real pressure from affordability limits and slowing demand. Across the state, inventory is building, homes are sitting longer, and price reductions are becoming more common. It's not a market collapse, but it is a correction, one driven less by panic and more by simple math. When incomes can't keep up with prices, something eventually has to give. That doesn't mean opportunity is gone. It means the market is resetting. Buyers who were locked out a few years ago may soon find a path in, while overextended investors might start stepping back. For homeowners, it's a reminder that location alone no longer guarantees growth. Fundamentals matter again. California's housing market has always moved in cycles. This one is different, but not unfamiliar. It's a cooling period after years of unsustainable heat, and what comes next will depend on how both policy and confidence evolve in the months ahead. If you found this breakdown helpful, let us know in the comments which city surprised you the most. And as always, make sure to subscribe to HouseLine USA for more data-driven insights on U.S. housing trends and where the market is heading next.